Hey everyone, and welcome. Today we're going to dig into the mind of a true legend, a guy who cracked the code on casinos and then took on Wall Street, the mathematician Edward Thorp. We're going to break down his method for mastering risk, a system that's just as powerful now as it was when he was turning the tables in Vegas. All right, let's just jump right in.
So let me start by asking you something. Imagine you have two choices. Choice 1, $3 million, right here, right now. Choice 2, a single penny that doubles in value every day for 31 days. What's your gut reaction? I mean, most of us would probably snatch that $3 million. It feels like a no-brainer. But what if I told you the no-brainer choice is totally wrong?
Because that one little penny, after 31 days, it doesn't just grow, it explodes to over $10 million. That is the mind-bending, almost sneaky power of compounding. It starts off slow, almost boring, but in the end, it's the engine that drives all serious long-term wealth.
And that brings us to the big puzzle, right? If the math of compounding is that powerful, then why do the numbers show that a huge majority, like 70 to 80% of regular retail traders end up losing money? Well, the answer isn't about math. It's about something much, much harder to control, the psychology of risk.
So here's our game plan for today. First, we're going to run through what I call the psychological gauntlet that every trader faces. Then we'll dive into Thorp's secret sauce, finding a mathematical edge. After that, we'll look at a formula called the Kelly criterion, which tells you how much to risk. We'll also face the very real danger of drawdowns. And finally, we'll pull it all together to see how you can build a real, lasting mental edge.
All right, Section 1, the psychological gauntlet. Look, before you can even think about winning, you have to understand the battlefield. And the market isn't just a bunch of charts, it's a high-pressure cooker that feels almost perfectly designed to make you crack.
And here's why. Think about this environment. You're swimming in constant uncertainty. You never really know what's next. Every single decision you make has immediate financial consequences. You see the profit or loss instantly. You're getting these super fast feedback loops that can actually teach you the wrong lessons. And on top of all that, you feel this constant pressure to do something. It's a combination that is practically guaranteed to wear down even the sharpest mind.
You know, most struggling traders think their enemy is emotion. They fight against fear, they fight against greed, they try to be a robot. But that's not it. The pros, they feel all the same stuff. The big difference is they've built a system to manage it. So the real problem isn't that you have emotions, it's that you don't have a rulebook that prevents those emotions from calling the shots.
And this slide just nails the difference. Over on the left, you've got the amateur. Their confidence is a total roller coaster, right? It's completely tied to whether they just won or lost, so their performance is all over the map. But now, look at the professional on the right. Their confidence is stable. Why? Because it's anchored to their process. They just ask one simple question: did I follow my rules? For them, a losing trade that followed the plan is still a success. And that tiny shift in mindset is everything. It's the key to psychological stability.
So how do you actually build a system like that? Well, this is where Edward Thorp's genius comes into play. He didn't try to get rid of his emotions. Nope. He built a fortress of math around them. He just focused on one thing: finding a statistical advantage or an edge, and then compounding it relentlessly. Thorp had this famous quote, "Gambling is investing simplified." What he was really getting at is that both worlds are fundamentally about the same thing: managing probabilities over the long haul. The exact same ideas he used to crush blackjack were the ones he used to build one of the very first quantitative hedge funds. It's all about playing the odds.
And the core of his entire method is this idea of expected value. This is just a fancy term for what we call an edge. Now, an edge does not mean you're going to win every trade. It doesn't mean you can predict the future. It just means you have a repeatable system that over hundreds of trades is mathematically likely to make more money than it loses.
Okay, so here's the math behind it. I know, formulas can look a little scary, but this one's actually pretty simple. All you do is take your probability of winning and multiply it by your average win. Then, you subtract the probability of losing multiplied by your average loss. That's it. As long as that final number is positive, even by a tiny bit, you officially have an edge. You're playing a game you can win over time.
And here's where it gets absolutely nuts. That positive number, no matter how small, leads to unbelievable results when you combine it with compounding. Get this, a trader who only wins 50% of their trades, literally a coin flip, can still pull off a nearly 97% annual return. How? It's not magic. It's because their average wins are just slightly bigger than their average losses. they have a positive edge, and they manage their risk like a pro. That's the whole game.
So, let's say you've done the work. You've found your edge. Awesome. But now you're faced with the next giant question. How much of your money should you actually risk on any single trade? It's a tricky balance, right? Bet too small and your account will barely grow, but bet too big and you could blow up. Finding that sweet spot is crucial.
And that is exactly the problem that the Kelly criterion was designed to solve. It's a formula that came out of Bell Labs, and Thorp made it famous. Its whole purpose is to calculate the perfect percentage of your capital to bet in order to get the fastest possible long-term growth.
And in its simplest form, the rule is right there. The percent of your money you should bet is your edge divided by your odds. But you don't even need the math to get the logic. It's just really intuitive. The bigger your statistical advantage in a situation, the more money the formula tells you to bet. It's a smart, dynamic way to size your positions.
But, and this is a really, really big but, we have to talk about where perfect math collides with messy human psychology. Because what is mathematically optimal isn't always something a real person can actually survive.
See, if you follow the Kelly formula perfectly, what we call full Kelly, you will technically maximize your long-term growth. But the journey to get there is brutal. It's incredibly volatile. It will expose you to these massive gut-wrenching drawdowns where you see your account value get slashed. And for most human beings, that is just too psychologically painful to stick with.
And that brings us to the professional's solution, fractional Kelly. So instead of trying to climb that treacherous, rocky path of full Kelly on the left, they take the smoother, safer road on the right. They simply bet a fraction of what the formula tells them to, maybe half Kelly, or even quarter Kelly. Sure, you give up some of that maximum possible growth, but what you gain is a journey you can actually stomach. Thorp himself said this is the way to go for pretty much everyone.
Okay, so let's pull all these threads together. Mastering the mental side of this game isn't about being born with nerves of steel. It's about building a tough, resilient process that marries a mathematical edge with a very honest understanding of your own psychological limits.
And this quote from Thorp just hits the nail on the head. He learned, just like guys like Benjamin Graham and Warren Buffett did, that temperament is what separates the winners from the losers. You could have the most brilliant strategy in the world, but if you can't actually execute it when you're on a losing streak, it's completely useless.
So how do you build that temperament? Well, you build it with structure. Step 1, make as few decisions as possible when the market is live and you're feeling the pressure. Step 2, set hard risk limits, like your fractional Kelly size, that you are not allowed to break, no matter what. Step 3, know ahead of time when you are going to walk away for the day, win or lose. And finally, number 4, when you review your performance, focus on your behavior. Did I follow my rules? That is the only question that matters, not how much money you made.
So if there's one thing you take away from all this, let it be this. The mental edge isn't something you're born with. It is built brick by brick. It's a system of rules you create that stands between your impulses and your wallet. The pros don't trust their gut feelings in the heat of the moment. They trust their process, and only their process.
And that leaves us with one final thought, a question for you to really think about. You can learn the math, you can find an edge, you can use the Kelly criterion to manage risk. All of that is learnable. But the real work starts after that. Is your mindset truly prepared for the journey?